Stop checking the price. For just a moment, stop. Because focusing on the price is the single greatest vulnerability for any investor. It creates the illusion of understanding while masking the profound systemic risks of the assets you own. That misunderstanding is a direct threat to your wealth. Because investors rarely lose money when markets are calm. They lose money when systems are tested. A silent threat in a bull market that reveals itself catastrophically when the system is under stress. What if the real story of Bitcoin isn't a sudden stroke of genius, but a brutal 30-year war to create digital money? A war fought and lost by some of the most brilliant minds of the 20th century. It's a story told through a graveyard of failed projects. Understanding why they failed is the key to understanding why Bitcoin wasn't just an invention, but an inevitable discovery. This isn't about getting rich quick. This is about defensive financial intelligence and the fundamental reinvention of money itself. To understand the system you're investing in, you have to go back. Back to the dawn of the consumer internet and a group of thinkers who saw the future with terrifying clarity, the cypherpunks. They were a network of cryptographers, scientists, and privacy advocates with one radical goal: to engineer money native to the internet, private, secure, and free from institutional control. They predicted that as our lives moved online, our financial infrastructure would too, and without a solution, that digital money would become the most powerful surveillance tool in history. Every transaction logged on a central corporate ledger, forever. They needed to build a digital version of cash, anonymous, peer-to-peer, and owned exclusively by you. But the moment they tried, they hit a wall. A problem so fundamental, it seemed to break the laws of digital physics. It's called the double spending problem. Think about it. Anything digital is infinitely reproducible. It's screenshot money. You can copy-paste text 1,000,000 times. So how do you create a digital asset that someone can't just copy, paste, and make themselves infinitely rich, rendering the currency instantly worthless? This was the puzzle that for 30 years, no one could solve. Our tour of the digital graveyard begins with the godfather of financial privacy, David Chaum. In the late 1980s, Chaum founded a company called DigiCash. His breakthrough solved privacy. A system of blind signatures allowed a bank to issue and verify a digital dollar without knowing who received it or where they spent it. It was truly anonymous digital cash, and it worked. DigiCash was even piloting its technology with major institutions like Deutsche Bank. For a moment, it looked like the war was already won, but it had a fatal flaw: centralization. While the transactions were private, the entire system depended on one company, DigiCash Inc. He had built an incredible system for financial privacy, but he was its single point of failure. Regulators saw a system for anonymous global payments, all flowing through one company they could pressure, control, and ultimately shut down. When DigiCash couldn't secure enough partners, it filed for bankruptcy in 1998. The first great attempt was dead, and the first law of digital money was written in stone. If it has a ruler, it will be broken. If it has a center, it eventually fails. This failure didn't kill the demand. A successor called e-gold proved people were desperate for an alternative. Launched in 1996, e-gold allowed users to transfer ownership of small amounts of real, vaulted gold. It became wildly popular, processing billions of dollars in value. Yet it made the exact same mistake. It was centralized. Every transaction cleared through one company's servers, making it a giant blinking target for the US government, who shut it down and prosecuted its founders. Here, we see a critical truth about engineering monetary systems, a truth that applies to our modern financial world. Systems rarely fail because the technology breaks. They fail because their control points become attack vectors. The lesson was now burned into the minds of every engineer. If your system has a head, it can be cut off. So how do you build a system with no leader and no center? This is the point where most people get lost in the technical weeds. But you're not most people. You're a system-level thinker, focused on the mechanics of how things fail. Understanding this next failure is what separates casual observers from serious investors. The next piece of the puzzle didn't even look like money. It came from a British cryptographer named Adam Back, who in 1997 published an idea called hashcash to solve email spam. The concept was genius. To send an email, your computer would first have to solve a tiny computational puzzle. For one person, it's nothing. But for a spammer sending millions of emails, the combined cost of that computing power would make their business model worthless. He had solved the problem of digital scarcity. Without a central authority, Back had invented an engine to create something digital that was provably expensive to produce. This was proof of work. For the first time, digital scarcity was possible. But hashcash wasn't money. It was just a clever component. You couldn't spend it, track ownership of it, or transfer it. It was a brilliant part, but the machine was still in pieces, heightening the frustration. Then, in 2004, a cypherpunk legend named Hal Finney connected Back's scarcity engine to a transferable currency. His system, Reusable Proofs of Work, RPOW, allowed someone to mine a proof of work token and then send it to his central server. The server would verify it, destroy it, and create a new tradable token registered to a new owner. He had solved transferability. We now had scarce digital tokens that could be passed between people. The solution felt closer than ever. But you can likely spot the fatal flaw. That central RPAL server. Hal Finney himself was the trusted party, accidentally recreating the very vulnerability that killed DigiCash and eGold. His server was the single point of failure that verified everything. The project never went beyond a prototype. Another genius had taken a shot and missed. The solution was within reach, yet remained impossibly far. If you find this analysis of how financial systems succeed and fail to be valuable, take a moment to subscribe. We go into this level of depth every week, and you won't want to miss what comes next. Our final stop before the breakthrough is with a reclusive genius named Nick Szabo. In 1998, the same year DigiCash went bankrupt, Szabo published a blueprint so close to Bitcoin, it's unsettling. He called it Bit Gold. Szabo's breakthrough was to combine the previous successes. He took Back's proof-of-work scarcity engine and imagined a system where computers would solve puzzles to mine new bits of digital gold. This made the tokens scarce and impossible to forge. Then he designed a way to track ownership. Each piece of bit gold would be tied to its owner's public key. To transfer it, you would cryptographically sign it over to the next person, creating a public chain of title, a ledger of all previous owners. The system was leaderless. The assets were scarce. Ownership was trackable. He was so close. But there was one final devastating problem. The double spending problem in its most monstrous form. He called it the problem of social scalability. How do you get a group of strangers on a network to agree on a single shared history without a leader? Think of a global scoreboard with no referee. Every player could shout out a different final score. There would be no way to know the truth. This was the flaw in BitGold. If a user sent the same digital coin to two people at once, which transaction was valid? Some computers on the network would hear one version first. Others would hear the second. The system would fracture. The scoreboard would shatter. Trust would evaporate instantly. Without a central authority to declare the official order of events, the network would descend into chaos. The currency would be worthless. Szabo, one of the most brilliant minds in the field, had designed a nearly perfect machine. But he couldn't turn it on. He couldn't get the players to agree on the score, and so BitGold remained just an idea. A brilliant blueprint, now the final, most haunting headstone in the graveyard of failed attempts. For years, there was silence. The problem seemed fundamentally unsolvable. You couldn't have a central leader, But without a leader, you couldn't have agreement, a paradox that had defeated the best minds for decades. And then, in the midst of the 2008 financial crisis, as the centralized, trust-based banking system was failing on a global scale, an anonymous paper appeared from a name nobody had ever heard of, Satoshi Nakamoto. The paper, titled Bitcoin, a peer-to-peer electronic cash system, proposed no single new invention. Instead, it was an act of pure synthesis. Satoshi had clearly studied the graveyard. They took the privacy ethos from Chom, the scarcity engine from Back, the transferable tokens from Finney, and the chain of ownership blueprint from Szabo. Satoshi gathered all the brilliant, failed parts of the rocket, and then they added the one thing everyone else was missing: a simple, elegant mathematical rule. A rule that finally allowed the scoreboard to work without a referee. A rule that let a leaderless network come to a consensus. It was the engine that solved the impossible problem. On January 3rd, 2009, the Bitcoin network came to life. Embedded in the very first block was a message, a time capsule defining its purpose. Chancellor on brink of second bailout for banks. It was a declaration. The old world of centralized trust is failing. Here is something new. So, was Bitcoin a random invention? No, it was a discovery. The inevitable outcome of a 30-year evolutionary process, built on a foundation of brilliant failures. The story isn't about one mysterious founder. It's about a generation of them. But what if the very rule that allows Bitcoin to survive also defines the one way it could ultimately fail? In our next episode, we will unpack the simple, powerful rule Satoshi created, the engine that finally allowed this machine to escape the gravity of centralization. Because every system built by humans contains a failure point, and the one vulnerability that still remains. This is the kind of financial history that provides a critical framework for understanding the systems we rely on. If this risk analysis was valuable, help others discover it, and make sure you're subscribed. For the long cycle financial thinker, the story is far from over.